in this AMT Insight, I'll be reviewing the key zinc price trends and drivers and offering some thoughts about the outlook for the zinc market and for prices. Now, zinc prices collapsed as much as 24% between mid-April and mid-May, and that was investors dumped risk assets amid mounting risks to global growth. These include China's COVID lockdowns in the last couple of months, the Federal Reserve's increasingly aggressive monetary policy tightening trajectory, and soaring inflation and the emerging cost of living crisis. Now, zinc found technical support from the 200-day moving average at the end of that sell-off, and it's since pared those losses reasonably substantially. It's in recent days been testing resistance as high as $4,000 a tonne. Now, overall in that sell-off, we saw funds with shorter-term behaviour largely liquidating their net long positions, although longer-term position funds maintaining that kind of bullish slant and bullish positioning in the market. Now, overall, the zinc market still remains fundamentally tight and inventory constrained. So that's despite this macro-led sell-off that we've seen, really. And you're still seeing these visible backwardations on both the Shanghai Futures Exchange and the London Metal Exchange. Now, in terms of moving on to usage, at a bit more detail on the outlook for usage, these heightened fears of a global economic slowdown have quite rightly created investor concern about the threat to consumption. And the expectation really is that you're going to see weaker zinc demand growth after the stimulus-fueled gains of the last couple of years. So the International Lead Zinc Study Group sees demand growth this year slowing to 1.6%. That's from 5.7% in 2021. Now, physical demand still remains pretty robust in the US and Europe. You've seen very strong construction activity, very much offsetting the automotive sector weakness that's been ongoing due to key component shortages such as semiconductors and wiring harnesses, made worse indeed as well by Russia's invasion of Ukraine earlier this year. However, monetary policy tightening and inflationary pressures still risk undermining this physical demand situation and strength, both in the second half of this year and into 2023. If we look at a bit more detail in China, it's clear that China's COVID lockdowns have severely hit domestic demand, although demand was very much weaker anyway, weaker than seasonally was expected after Chinese New Year early this year. And that was partly because of the ongoing weakness in the property sector. Although the easing of China's COVID curbs and the stimulus measures that it's announced to try and support economic activity should support a rebound in zinc use in the second half of this year, the rebound and recovery is likely to still be quite gradual, and really we're below the baseline of where we expected we would be with China earlier this year, with China now as a consensus unlikely to hit its 5.5% GDP target for 2022. I think an uncertainty for metals demand is that, if you were to see some very big and large-scale infrastructure spending commitments, then that could indeed accelerate the rebound in metals demand particularly. So that's really what we're looking for to try and see some above expectation and above a gradual rate of rebound in metals demand particularly. Now, in terms of mine output, global mine output is set to slow in 2022. You have Neves Corvo in Portugal ramping up production after an expansion, but you've had flooding at the Poco mine in Burkina Faso, you've got the planned closure of Hudbay's 777 mine in Canada, and you've got this ongoing social unrest in Peru. So all that will kind of weigh on mine output growth overall this year. Now, in terms of concentrate availability in the global market, that's outside China, that's much improved, and that's really been a reflection of the smelter output constraints we've seen in Europe because of high energy prices and the reduced China import demand because of the current LME premium to the Shanghai Futures Exchange prices. China's domestic market for ore, conversely, is quite tight because, again, of those reduced imports of ore because of the arbitrage situation and because of lower seasonal winter domestic production in Q1. So zinc production in China, zinc ore availability in China fairly weak, and the lower TCs as a reflection of that should be fairly supportive of mine supply growth domestically in 2022. The ILZSG sees that at 2.3% this year. Now, in terms of refined zinc output, really this is the key question for supply. So the active smelter capacity is really the key bottleneck for global production rather than mine output really this year. That's all to do really with the European zinc smelter output disruption because of high energy prices, and that really remains the key sensitivity for the rest of this year. The extent to which prices maybe subside or they move higher is going to continue to have implications on European output and global output overall. At the moment, the International Lead Zinc Study Group is forecasting a 0.9% rise in global refined zinc supply. Now, in terms of global inventories, we still have a situation where you see these regional shortages, particularly in the US and Europe, but outside China more generally, really. You've basically got no available LME inventory outside of Asia. You've got a bit of cancelled inventory in the US. And you continue to see high physical premiums in the US and Europe reflecting those shortages, really. And that's partially because of the broader deficit in the global zinc market, but also because of ongoing global shipping disruption that continues to be a barrier to trade of metal between those regions. Now, the situation is clearly a bit different in China because of the impact of COVID curbs, and that's been quite clear in the last couple of months. If we look at Shufi zinc inventories in comparison to recent years, you'll see that there hasn't been the same usual seasonal destocking that you might have expected to occur in Q2. Again, the uncertainty here is if China can successfully and gradually rebound from these strict COVID measures that it's currently got implemented, then a renewed drawdown in Shufi inventories is probably likely, although it's probably far from a certainty. There's still the possibility of fresh outbreaks of COVID in China that will remain a risk and a headwind. Now, overall, the International Lead Zinc Study Group sees a 292,000 tonne market deficit for zinc in 2022. Now, that's still pretty significant, and that's equivalent really to 2.1% of global consumption. So, in summary, really, there's no doubt that zinc is swimming against this growing tide of global growth risks in 2022, and that's most likely to continue into 2023. However, I think we have to be cognizant that the physical inventory constraints outside China, the global market deficit projections, which are still fairly significant, and the potential for a China demand rebound in the months ahead should offer zinc prices a fair degree of insulation from these underlying global economic headwinds. So, still at risk on the macro level, but the fundamental micro level should offer some support, I think. Now, that's it for this insight on the zinc market. If you continue to find the insights we're putting out on a periodic basis interesting, very much encourage you, if you haven't done already, to follow, subscribe to alerts, or subscribe to our LinkedIn channel. And the details are above me in the description.